Welcome to the Big Tech is Back webinar hosted by Evolve ETFs. I'm Pablo Fuchs, editor of Globe Advisor at the Globe and Mail, and I'll be moderating this discussion. Before we begin, some quick housekeeping items. This presentation should last about 45 minutes, followed by some questions from the audience. If you have a question, simply type it into the Q&A section, and we will get to it toward the end of the presentation. We're joined today by Kaitlin Thompson, Vice President Product Strategy at Evolve ETFs, a Toronto-based ETFs provider with more than $6.2 billion in assets. Her responsibilities include product creation and national accounts distribution. Prior to joining Evolve, Kaitlin was at Mackenzie Investments. She graduated with a Bachelor of Commerce from Queen's University and is a CFA charter holder. And our other panelist is Dr. Ed Yardeni, President of Yardeni Research, a sell-side consulting firm that provides a range of global investment strategies, as well as asset allocation analyses and recommendations. He previously served as Chief Investment Strategies of Oak Associates, Prudential Equity Group, and Deutsche Bank's U.S. Equities Division in New York. He was also the Chief Economist of C.J. Lawrence, Prudential Beige Securities, and E.F. Hutton. He taught at Columbia University's Graduate School of Business and was an economist with the Federal Reserve Bank of New York. Ed also held positions at the Federal Reserve Board of Governors and the U.S. Treasury Department in Washington, D.C. Ed earned his PhD in economics from Yale University in 1976, having completed his doctoral dissertation under Nobel laureate James Tobin. Previously, he received a master's degree in international relations from Yale. He completed his undergraduate studies magna cum laude at Cornell University. Ed is frequently quoted in the financial press, including the Wall Street Journal, the Financial Times, the New York Times, the Washington Post, and Barron's. He was dubbed Wall Street Seer in a Barron's cover story and appears frequently on CNBC, Bloomberg Television, and Fox Business. Okay, let's start off by taking stock of where we're at. Big tech stocks were the big winners during the post-global financial crisis and pandemic bull markets, but languished last year as interest rates soared. With an economic recession likely down the road and interest rates still high, Ed, what do you feel has led to the resurgence this year?
Well, I think it started when Netflix and Facebook responded to their falling stock prices by cutting costs and by changing their business model, tweaking their business model just a bit. And as a result of that, investors suddenly realized that these 7 or 8, I like to call them the mega cap 8, that would include Netflix. So the mega cap 8 stocks demonstrated that they have tremendous ability to generate cash and that they can easily increase their profits simply by cutting back some of their costs and some of the costs related maybe to R&D, whatever. But these are extremely profitable, cash-rich kind of companies. And as a result, collectively, they now account for 26% of the S&P 500. I know there's some talk by the naysayers that this is all a bubble and that it's artificial intelligence hype and that it's reminiscent of the dot-com bubble, but I don't see that analogy at all. These are very profitable companies, and we may just have to learn to live with the fact that eight companies account for a quarter of the S&P 500.
And Kate, what do you have to add to that?
So I would definitely echo what was just said. I think a big portion of it is kind of this rotation back to growth that we're seeing from a lot of investors. And I think that's driven by hopes that the Fed will pause rates, which I think is very relevant because I was just checking my screen and it looks like they did decide to hold interest rates where they are right now. And then also investors looking down the line to eventually see them cut rates, which will obviously benefit some tech companies. I think investors also favor the bigger and the safer mega cap tech companies because they have strong balance sheets, they have improving fundamentals, and they just have strong moats around their business. And I touched on it a bit. Definitely, I think the AI revolution has I don't think it's necessarily created a bubble, but I think it has helped some of the resurgence in these big tech names. AI has definitely been around for a while. But I think what's changed is the launch of ChatGPT made the idea of generative AI tangible to the average investor. We compare this at Evolve a lot to when we launched our cars ETF back in 2017. Investors weren't as interested in electric vehicles because it wasn't a prominent part of their life. They weren't seeing electric vehicles on the road. They couldn't relate to it as much. But as investors started noticing that theme in their daily lives, investor interest kind of increased, and then performance also followed. So I do think there's a little bit of AI hype that has helped prop up some of these big tech stocks as well.
Great. I want to dig into the improving fundamentals there. In fact, I want to cite a recent report from Shorters, which suggests that the better performance for these firms is strictly credited to the improving fundamentals, both the top line and bottom line. And as well, as you pointed out, Ed, some cost-cutting initiatives that you mentioned. So wanted to get your take on in terms of where their fundamentals are so strong for these organizations in terms of their financials that they're attracting so much confidence among investors.
Well, I think the fact of the matter is these are the largest market cap companies, certainly in technology. I mean, there's a few others that also are large cap but aren't necessarily the biggest companies, but there are many of these mega cap 8 companies have demonstrated that even though they are large, they've been able to maintain a very high growth rate, which is something that's really quite extraordinary. Usually in the past, we're used to the idea that companies grow rapidly when they're small, mid-size, and then they mature and their growth rate slows down. That has not been the case in the example of these companies. They're multinational. They do business on a global basis. They certainly have lots of potential to do more business as they get into different modes of business. They're constantly using their cash flow to do very state-of-the-art research and development. And you just never really know exactly what they're going to come up with. I mean, Amazon was just basically an online retailer with a very small margin, and all of a sudden they started making a fortune in the cloud by sharing their servers. Microsoft has done very well with its Office suite and basic software packages, but now it's taking a leadership role in artificial intelligence. They've already introduced it into their software. Bing can be used with artificial intelligence. But the thing is that it's not just artificial intelligence, it's also robotics and automation and nanotechnologies. There are all these technologies that are getting integrated in a way that can increase productivity of any business. If you recall, back in the 1990s, we had a technology revolution, but back then everything was kind of clunky. It was these, big computer monitors and with the boxes behind them. Smartphones weren't smartphones; they were cell phones, and they were the size of a brick. But back then, that revolution basically was led by 2 software programs, and that was Excel and Word. So if you had a whole bunch of people sitting on electric typewriters typing all day, you could replace that with Word. If you had a whole bunch of accountants putting in manually to written spreadsheets, you could replace that with Excel. But there's only so many businesses that really could use that, or where it could really make a big difference. Now these technologies, when you integrate them all together, they do a heck of a lot more, and they're applicable to every business. One more thing I'd like to point out is that this technology revolution is in many ways about the brain. It's augmenting the brain. I mean, we're all humans, and some of us are smarter than others, but we all have a memory issue. There's only so many things that we can remember. My wife remembers everything. I don't remember anything. But having the ability to have all the available knowledge at just by talking to a computer is really quite awesome. I've been using it in my daily writings to whenever I need a date for some event that occurred and I forget exactly when it was, I describe it, and more often than not, I get the right answer. I mean, sometimes you have to double check these things, but at least it gives you something to work with.
Well, that's great, and I definitely want to dig into some of those subjects further on in the discussion. Okay, turning it over to you. Where exactly does all this leave big tech firms within the broader market in terms of size, scope, and how does it compare to some of the other sectors?
Yeah, so I think the short answer is it leaves big tech bigger than it's ever been. I think earnings season, as Ed mentioned, really did start to propel this divergence even more. I read a stat that about 75% of tech firms beat expectations, and that's compared to a fairly mixed picture across a lot of other sectors. I also like to point out an interesting stat that I find is when you look at the comparison of the S&P 500 or the NASDAQ 100 market cap weighted version, and then the equal weight equivalent. And the S&P 500, as an example, is up 14% around year to date. And in the equal weight version is up only 4%. For the NASDAQ 100, that difference is even bigger. The NASDAQ 100 is up about 37%, and the equal weight version is up only 20%. So I think that really does speak to the growth that the mega eight or the big tech companies have really shown, and the dominance that they have in the market. I think to name one in particular that I think stands out in most investors' minds is Apple. This week, Apple closed at a record high, and it's close to a historic $3 trillion valuation. And Apple really is seen as a favorite among investors, regardless of the market condition. And I think I kind of mentioned this earlier, but it was viewed as a safe haven during all the banking turmoil this year as well, just given that the balance sheet strength and durable revenue. And I think it just shows that investors are comfortable owning Apple, whether it goes up or down in the short term, because they're confident that they will eventually make money with it over the long term. And I think a lot of those dominant characteristics are found in a lot of other big tech companies like Google, like Microsoft. And I guess the one other thing I would add to the question around kind of how its dominance is going to continue is beyond investors actively choosing to favor big tech and have Apple in their portfolio and have Microsoft in their portfolio, their dominance will also just grow given their position in a lot of the largest index funds. So as many of us know, a lot of investors are sitting on the sidelines with significant portions of their portfolio in cash right now. And as they get ready to move money into the equity markets, a lot of money will flow into these big tech companies just because of their allocation. They're weighting in the S&P and the NASDAQ, and even in larger actively managed funds. And I think this will just continue to propel their growth and their dominance further.
Oh, that's great. And want to flip back to one of the subjects that's come up a couple of times, and obviously one of the big news stories of the year that is debatably a factor in the growth of these companies is the rise of AI, with some saying it could lead to the next phase of the tech revolution. In fact, Ed, you've been on record saying that the rise of AI could spark a roaring 20s for stock markets. Yep. So which players have benefited most from this so far, and which ones are likely to be the big winners in both the short and long term?
Honestly, at this point, it's too soon to tell, but I've got this idea that perhaps we need to think of all companies as technology companies. And what I mean by that is that if you don't incorporate the state-of-the-art technologies that are available now and will be introduced over the next several years, if you don't do that, then you're going to be left behind. You're not going to be increasing your productivity. You're not going to be augmenting the productivity of your workers, and your competitors that are using the technologies will in fact be able to outrun you. And so I think there's a tremendous amount of pressure on all businesses to get tech savvy. You know, I'm sure all businesses are basically asking themselves, how can I use artificial intelligence in my business? I've got a small little research firm, and I've been getting emails from people saying, well, let us show you how to use artificial intelligence in your business. I'm sure they have not a clue what I do for a living, and it's just totally kind of a spam that's being sent. But clearly the entrepreneurial juices of a lot of people are flowing in response to this particular technology. But again, I think once you become more tech oriented and hire the right people or have the right consultants, they're going to make you realize that it's not just about AI. There's others technologies that integrate all together to increase productivity. And especially now when we've had a pretty bad couple of years of productivity because of the high quit rates, the turnover in the labor market, companies are starting to realize that there's a real labor shortage, and that the only thing you can do about it, other than raising wages and just kind of getting into that whole wage price spiral, and that doesn't work, obviously. You pay more for workers, they go somewhere else because somebody else is paying them more. So I think companies have to focus on the labor shortages by, in fact, using technology to augment the productivity, efficiency, smarts of the workers they have, and in doing that, increasing their profitability and using some of those profits to pay their workers more. Also, I think the technology is exciting. It gives people, it takes the mundane out of a lot of businesses and creates a lot of upside potential for people within an organization to do something smarter, better.
Great. And Kaitlin, turn it over to you in terms of the approach that you're taking at Evolve. Can you give us a sense of what you feel in terms of AI, the factor it's the part of the puzzle that it's played so far, and the factor that's going to play in the future?
Yeah, so I think so far, a lot of the beneficiaries have been, I'll kind of break it down into three buckets in my brain. I think big tech has seen obviously a big appreciation. You have names like NVIDIA up 170% this year, or Meta up 125%. Even Microsoft is up, I think, almost 40% since it's announced its investment in OpenAI. And Google's up 40%. So big numbers for a lot of these big tech companies. I also mentioned NVIDIA, but there's also names like AMD jumped yesterday after it revealed a new AI chip, and TSMC also on the AI. So I guess semiconductor companies have also been a beneficiary because a lot of these chips will power the AI bots. There's also some smaller pure play AI names that have done well this year. Like C3 AI is one that comes up in some conversations. It's a small firm. They are a leader in providing enterprise AI software, and it's up over 200% year to date. So there's been different companies that have been beneficiaries of the craze so far. But I think, to Ed's point, we are extremely excited about the AI theme. We think it's a long-term investment theme that will be relevant for many, many years to come. And I think it will truly disrupt every industry. It's not unique to tech. I was reading this McKinsey article that said AI could generate up to $4.4 trillion of value across industries. And yes, tech was up there as one of the industries that it could benefit, but retail, banking, logistics, like the list went on of the industries that it could touch. And I think that's what people are so excited about, just the scope of this revolution. I think the last thing I would add is I do think over the longer term, big tech is in a position to potentially benefit the most. I think, and the reason I say that, again, it's too soon to tell, so who knows, but they have access to all the data. And the data is required to actually train these generative AI models. We often say at Evolve, data is the new gold, and they're kind of the keepers of it. And they also have the cash on hand in a lot of cases to maybe buy up some of these smaller pure play AI companies as well. So I think it's a really interesting theme to watch, and we'll be closely monitoring it at Evolve.
Great. So I want to turn the attention a little bit. You cited some smaller players there, and there was a recent interview from George Ball, who's chairman of Sanders Morris Harrison in Houston, and he said about 6 weeks ago that big tech's rally has now run its course, and smaller tech stocks will lead the market for the rest of the year, mainly because of their potential for revenue growth. Ed, you cited also that the revenue growth has continued among big tech. So yeah. Do you agree, disagree with this approach? Why or why not? Kate, let's start it with you there.
With me? You want to start with me?
Yeah.
Okay, so I think it's possible. I think big tech might not have the same revenue growth prospects as smaller companies, just by virtue of size. However, as I do think investors will always favor big tech, and that we've kind of mentioned this, but the big tech companies do dominate so many areas, whether it's artificial intelligence, whether it's cloud computing, consumer electronics, e-commerce, streaming, social networking, advertising. Like you could go on and list the areas of the technology sector that they dominate. I also think that big tech will likely still come out on top because it's a good spot for investors potentially, regardless of where the economy goes this year. I think big tech will benefit as the Fed eventually starts to cut rates. Obviously, maybe they won't rally quite as much as smaller cap tech companies, but you'll still see that benefit. But then also if rates stay higher for longer, they're the ones with the bigger balance sheets that can weather the storm of a higher rate environment. And I guess the last thing I will mention is on the topic of big tech, I think where we keep grouping them all together, but there is also a divergence in performance across them. And Amazon is a specific one that I bring up a lot. Amazon has been kind of at the forefront of the rally this year. It's up 50% year to date, but it's actually the furthest from its record peak. So it's still trading about 32% below where it was in July of 2021. So suggesting that maybe there's more room for Amazon to run compared to an Apple and an Nvidia that are trading at all-time highs.
Great. And Ed, what's your take on all this?
Well, it doesn't really have to be an either or. I mean, it could be both. The extent to which technology is becoming a key driver of the economy, then I think there's opportunities across the spectrum. I would point out that one of the advantages that the mega cap 8 have right now is that they are generating a lot of profits and a lot of cash. They don't have to go to the bank. They're quite the opposite. Their problem is they've got so much cash that they have to buy back some of their shares on a regular basis, and that is another positive factor in their favor. But in the current environment, with interest rates up, with the Fed having been tapping on the brakes, maybe slamming on the brakes too, for some participants in the economy, there's a real shortage all of a sudden of venture capital. Venture capital had been sort of the Wild West, anything goes, and over the past year or so, things have slowed down quite a bit. So it's hard for small startups to easily find venture capital. However, the mega cap 8 certainly are in a position to fund a lot of new technologies, a lot of new innovations, which means that they'll wind up either owning or at least being the initial seed money for some really great technologies, and that will allow them to buy them up and incorporate them into their business, as opposed to kind of watching them raise money from Wall Street or venture capitalists on Sand Hill Road and then become big companies. It may be frustrating to buy small tech companies because you may never be able to let them. They may not be able to grow into Googles and Microsofts and Facebooks because those companies will wind up buying them.
Yeah, no, for sure. And obviously, the recent collapse of Silicon Valley Bank has added to all that because it was a major funder to a lot of startups. So does that create, just as an add-on to that question, does that create an opportunity for big tech to get really aggressive in acquiring startups and, of course, essentially making them even bigger?
Yeah, the short answer is absolutely. Yeah, I mean, it's yes. And again, I think that they are in the driver's seat. They're in a position to know virtually everything that's going on. I mean, let's face it. These days, if somebody's got a great idea and wants to fund it, they're on their list of who to approach is going to be some of these big companies.
Mm-hmm. No, definitely. So, want to separate some of the differences between big tech, because as we know, they all get lumped in together, if you will, regardless of how we call them, whether it's FANGMA or the Big Eight, etc. As we know, FANGMA, of course, those have been big providers of results, and Evolve's ETF on this is up 50%, if I believe so far this year, right, Kate? But of course, there are differences between these companies. Kate, you mentioned a little bit about them. Maybe you can give us a sense of how the fund works, and in the short term, what's the outlook for these companies this year, and which ones are you most excited and concerned about as we head into the back half of 23?
Of course, yeah. So our big tech, or FANGMA ETF, goes by the ticker TECH, TECH. It's a very simple product. It gives investors exposure to the 6 FANGMA stocks. So I'll say it out loud just so we can all hear the names, but all names we're familiar with. Facebook, Amazon, Netflix, Google, Microsoft, and Apple. The strategy is index-based. As I mentioned, it's equally weighted and it's rebalanced quarterly. The idea actually came from a large advisory team in Quebec that approached us, because the immediate reaction some advisors give us is, oh, well, I already own all these companies. Why do I need another ETF to give me exposure to them? And there were some operational reasons why we decided to launch the product, and why it's been one of our most successful, steady growing products since launch. One of the reasons is it's considered domestic property for estate tax purposes. Obviously, if you're holding Facebook stock or Meta, I guess I should say, or any of those US names, it would be considered foreign property. So that's been one thing that advisors have been interested in. Also, this argument is a bit less relevant now that there's been some stock splits, but it used to cost about $7,000 to buy one of each of these stocks. Now it costs about $1,500. Versus, though, you can get exposure to all the 6 equally weighted for $10. So it's easier for smaller accounts, can be easier for rebalancing purposes. And it is also offered in 3 different currency options. So you can get Canadian dollar hedged, Canadian dollar unhedged, or US dollars. In terms of our outlook, I think our outlook is strong for these companies over the short, medium, and long term. We think they are dominant in the market and will continue to be, for all the reasons that we've mentioned throughout the webinar. I think AI is the most recent theme that we're excited about, but these companies lead the cloud computing market. They have made big strides in cybersecurity. There's just so many areas that these companies dominate that it's hard to see them really going anywhere in the future. In terms of excited at one company we're excited or concerned about, I guess for me, like Microsoft seems exciting to me. I think their investment in OpenAI has put them kind of in the front run of this AI revolution potentially. And I see a lot of potential integrations into their Office product suite that I think could impact hundreds of millions of people every day. But there's lots of reasons to be excited about a number of all these companies. The one concern, I wouldn't say we're concerned about it, but it is one that comes up in conversations with advisors. So I do think it's worth mentioning. Netflix is obviously the smallest one of the bunch. Streaming does continue to be a relatively crowded industry, especially as a lot of these legacy television networks are entering into the space as well. And also Netflix doesn't have the same diversification of business units, I guess, as some of the other big FANGMA companies. But it's worth mentioning, it has been one of the best performing names in the fund over the last year, alongside Meta for that matter, who both actually led the declines in 2022. So I think that goes to show that despite you can't just buy one big tech company and expect you're going to get exposure to the bunch. It's really beneficial to have a diversified approach because they won't all perform necessarily in line. And at the end of 2022, we had advisors knocking on a door saying, "Why is Netflix in it? Can Netflix go out of the product?" And if we had done that, we would have liked performance because it's up over 130% over the last year. So yeah, I think that just emphasizes getting a diversified approach via an ETF like tech.
Great. And just before we turn it over to Ed for his part of the question here, if you have any questions for our panelists, please make sure to enter it in the Q&A box, and we'll get to them at the end of the presentation. So Ed, want to turn it over to you. Looking beyond that, which areas of big tech have the most promise, and which of these companies are likely to benefit from that?
Well, I'm not a tech analyst per se, but I'm a tech enthusiast. As I said, we have our own little research shop, and we've had a very crude artificial intelligence system where our chart program would ask our data vendor if any new data became available, and on a nanosecond basis, the system would download into our chart program, which would automatically upload the chart. So we've sort of created our own little tech world here, and we've had lots of different software platforms that were hard to integrate, and we found that one or two of these new platforms could really do a lot for us. So I think there are lots of small and mid-sized businesses that are doing the same thing as we're doing, constantly looking for ways to make things simpler and better. And what we've observed is that the cost of technology just keeps coming down, and its power continues to increase. So from that point, it's very exciting. But I think that one thing leads to another, as Kaitlin pointed out. If you've got suddenly this AI really takes off. I know I signed up for AI Open, and I'm paying $20 a month, and I'm not using it as much as I should. But as people are kind of tuning in and signing up for these things, it increases the need for cloud computing and storage. It increases the need for data centers, and in addition to the services, it increases the need for semiconductors and simply more technologies of every kind. So again, I think it's sort of it's not a brave new world, but we've been sort of evolving into a brave new world. I think, as Kaitlin said, the AI is not exactly something that just happened, but from the point of view of the public and business managers and decision makers, I think that ChatGPT really opened people's eyes to what the potential is of just this one technology. And I think once you open your eyes to one technology, it makes you realize that maybe you ought to become a little bit more informed about what else is available out there.
Great. So thanks a lot, Kate and Ned. Just want to know if you have anything else to add before we turn it over to our audience questions.
No, I'm good. I think we covered a lot.
Yeah, me too.
Great. There's one question here. You mentioned the Mega 8. Apart from the 6 FANGMA companies, which companies make up the other 2, and what makes these 2 companies stand strong with the other 6?
I think I'm not sure about the 6, but I know that Tesla and Netflix and Microsoft and Google and they round up the usual suspects. Nvidia, they're in there. When this concept first started out, I think there were 4 of them, and then there were 5 and then 6 and suddenly 7 or 8. Maybe that'll continue to be the case. Maybe we'll find that there's more winners than we possibly thought. But as you said, they're not all, from the S&P 500 perspective, they're not all tech companies. 2 of them, Google and Facebook, are included as communication services. Amazon and Tesla are included as consumer discretionary. And then, hardcore tech would be Apple and Nvidia and Microsoft. Great.
Kate, I want to ask you the next question here. You mentioned Apple and the confidence that investors have in this company. As we saw last week, they introduced this new ARVR platform, which, as we know, Apple tends to take platforms that are niche and then makes them mainstream. Of course, the price tag is huge, and still looks like very early days. But do you see this as another area of growth, not just for Apple, but for other organizations within the big tech, in terms of ushering in a new era or a new type of product of technology here that's going to impact businesses and consumers?
Yeah, so I think the metaverse is a really interesting topic too. We launched a Canvas First Metaverse ETF as well, about, I guess it was November of 2021, basically right before the market kind of started to tank. But if you remember back to then, that was kind of the craze. Everyone was talking about the metaverse in their earnings reports, how we're going to integrate it into our business models. I think Meta came out with their version of a VR headset that hasn't. It's more priced for a retail customer, but it hasn't necessarily taken off quite yet. I think Apple getting into it really just shows some really strong potential future growth. I think what's interesting about the VR headset, and a lot of pushback you can get from people, is they can't imagine putting on a headset and living in a virtual world. We typically all like reality and the real life, and we don't want to just sit in our room by ourselves with a headset on. But I think what it actually ultimately will hopefully do is it will just kind of enhance the experience that we have with the internet right now. Whether it be we put on a headset to enter a meeting and it feels like you are in the room with other people that are sitting across the world, maybe across the country, across the world from you. Or going to attend a concert virtually makes it way more accessible to different types of people. Education is another example. Children's education, being able to actually put on a headset and enter into the world, into the either the time period or the place that you're learning about. I think there's a lot of interesting applications to the metaverse. I think we're a little bit further away from it being a part of everyone's daily life, but I think it's really exciting that Apple has launched a product in the space, and it's something we'll definitely be watching.
Great.
By the way, I think the price is high, but I think as apps are introduced for this device, we'll find that businesses find it a very useful tool, especially in an industrial setting or even a medical setting. You know, doctors may very well wear these goggles that'll kind of follow what's going on and give some suggestions along the way. And so I think we're just in the very, very early stages of AI, very early stages of the goggles. And I think the goggles is an example of how we can combine artificial intelligence with this device to do things that we simply weren't able to do before. Instead of having to go look for, if you're a mechanic and you have to look for information, instead of having to dig it up out of some manual, to be able to call it up very quickly would save a lot of time.
Great. And I had a question here for you. How do you see Microsoft Activision deal affecting the other big tech players as they try to diversify and expand their business lines?
Well, I think that gaming has been something that Microsoft's been in for a very long time, and so this is really just an effort to grow that business. I mean, Microsoft, like the other companies, has demonstrated that they don't get into businesses just to stay in one place. They intend to grow them and see what their potential is. I mean, NVIDIA basically started out as a chip company for gamers as well as for Bitcoin miners, and now all of a sudden it's a artificial intelligence behemoth. And so we'll see. I mean, I guess there's still the question of the government's concerns about regulatory issues, but these companies are aspirational for sure, and that's a good thing. But it also can run into roadblocks along the way.
Terrific. So let's see. Any other questions here? And can you please expound on the Roaring '20s comment? What similarities are you seeing from the previous 20s to these 2020s? And with that, what can we expect in the coming years?
Well, I think that besides rhyming 1920s and 2020s, there are some interesting similarities. The 1920s, a couple of years before that, there was what then was called a world war. It was called the Great War because it's the only one that there was no World War II. Millions of soldiers and civilians died in that war. And then we had the Spanish flu right after that, 1918, 1919. And in the US, we then had a depression in 1920. So anybody kind of thinking about the decade ahead in 1920 had to be awfully depressed about things not getting any better and maybe even getting worse after all these plagues had befallen the world. Now we've had a lot of pessimists looking out over the decade and seeing recessions, seeing a shortage of workers, seeing that growth isn't going to be very good, worrying about inflation. And I think especially economists tend to be pessimistic. And I think one of the reasons is that they just ignore technology. Technology solves problems. And, so we've got a labor shortage problem, and technology is going to solve that. We've got an inflation problem, and technology is going to solve that problem. So I'm very optimistic about the potential for technology. Now, what's different about the technology revolution now and in the past, especially if we're talking about the Industrial Revolution, a lot of that technology was aimed at brawn, how to substitute efficient machinery, steam, electric power for physical labor. Now we're working on the brain, augmenting the power of the brain, which is a radically different way of increasing productivity. And I think we've, as I said before, back in the 1990s, we had basically Excel and Word, and that was about as exciting as it got. We did have a big increase in productivity, mostly because we were manufacturing more computers, but it's not clear that they did a great deal for other companies. Now that's all changing, and I think these technologies have the potential to increase the productivity of any company that chooses to look into them and to incorporate them. So I think technology is going to be a driving force of the remainder of the decade, just the way it was in the 1920s. I think that will enhance productivity. I think that'll increase real incomes, keep inflation down, and should be the rest of the decade should be quite good in that kind of situation. I know some people will say, well, yeah, but it ended with a great crash and the Great Depression. We still got some time. Ask me along the way whether everything's going to blow up at the end of the decade. I don't have any particular reason to believe so. I think the 29 and 30s calamity was initially caused by the Smoot-Hawley tariff, but that gets into a whole different kind of conversation.
Great. And I think that's a great point on which to end the discussion. But before we go, Kate, I want to turn it over to you. Maybe you can give us an update on what you've been working on over at Evolve and how advisors can get more information from you and your organization.
Yeah, so we'll give like a quick 1 minute update, I guess. We've been really proud of our growth at Evolve over the last, 5 and a bit years. We're managing over $6.2 billion right now. And that makes us one of the fastest growing ETF providers in Canada. We have seen a ton of growth in our high interest savings products. So cash alternative, cash is king right now. A lot of advisors are talking about that. We've also seen a ton of growth in our covered call ETFs as well. Because high volatility in the market has led to these strategies outperforming. And then also Canadian investors love yield. And then I guess the other aspect, which we did touch on a little bit here, is the disruptive innovation area of our business, which we have created quite a reputation for ourselves in. But nonetheless, you can access any information on our website, which I think you can see on the screen there. You can reach out to myself or anyone at the Evolve team, and we'd be happy to answer any questions.
Great. And concluding with you, how can advisors and investors access your research, and tell them a little bit about what you're working on?
We have two levels. We've got the institutional research, and then a year ago we created a product for individual investors, for FAs. Though we've got FAs investing, not investing, but let's call it investing. Hopefully when they spend money on our research, they make a lot more money, but that's the whole goal here. But for the sort of a tasting menu, you could go to YardeniQuickTakes.com, as you can see on the screen. You can also sign up for a 4-week complimentary trial of our institutional product.
Great. Well, I think that wraps it up for today. I want to thank you all for joining us, and special thank you to Ed and Kaitlin for joining us for today's conversation. Hope you all have a wonderful afternoon, and that concludes our webinar. Thank you.